Good evening, everyone, and thank you for joining us. We will begin shortly. Thank you for joining us, everybody, for our webinar tonight, Who Needs the Lottery? My name is Will Crosswell, and I'm the Vice President of Service and Sales for the Credit Union. And I'm coming to you live from my living room, probably like many of you are this evening. So we're happy that you're here with us again. If this is not your first webinar with us, and if it's your first time, glad you joined us. And we know we have a lot going on in our lives right now, and know that Ardent is here for you. So if you have any additional banking or borrowing needs, please keep us in mind. So if you need to ask a question during the workshop, please click the Questions tab and type in your question. The photo to the left is the screen of an iPad, and the photo to the right is the screen of a desktop. We have Lisa from Ardent's marketing department on the line, who will relay the questions to Andrew during the seminar. There will also be a Q&A session after the workshop. So if you're viewing the workshop from a smartphone, as a friendly reminder, you will have to swipe right to see the PowerPoint. So let me introduce our speaker this evening. Andrew Campbell is a CFS licensed financial advisor with Ardent Investment and Retirement Solutions. A graduate of Gwynedd Mercy University, Andrew has an MBA with a concentration in strategic management. He has 13 years of experience in the financial service industry. Whether his clients are interested in accumulating wealth, investing for retirement, education expenses, or some other goal, he helps them make informed financial decisions and designs a custom investment strategy. When not hard at work, Andrew is active in the Rotary Club of Bluebell. Join me in welcoming Andrew Campbell. Andrew, take it away.
Yes, thank you. Thank you very much. Will, really appreciate the introduction. Again, my name is Andrew Campbell, licensed financial advisor with CUSO Financial Services at Ardent Credit Union. I currently hold a Series 7, 63, 65 in various insurance licenses in multiple states. I was originally sponsored by MetLife back in 2006, and I've worked for small bank programs and large bank programs, worked as an independent advisor for a period of time until I finished my advanced degree, and then I decided I wanted to come work here with the good people of Ardent Credit Union. And I have to say, they are a very high caliber of individuals, and it's a distinct honor and pleasure for me to work so closely with the good folks of Ardent. The slides sometimes pause at first, but once they start clicking, they tend to move along pretty smoothly. I'll try that one more time. There we go. A little bit of legalese. CUSO partners with Ardent, and we offer various products. And some of these products are not federally insured, and in certain cases, some of these products may in fact lose value.
Hi, Andrew. This is Lisa. Could you please turn your webcam on?
Oh, I am terribly sorry. There it goes. Thank you, Lisa. I apologize for that. So the question is, who needs the lottery? Well, I do. I love playing scratch tickets with the wife. It's something we do quite often. Probably spent and lost a small fortune doing it. It's fun, but I'll tell you, it is not really proven to be a very viable retirement strategy, and for that matter, a strategy that would even generate wealth. As we let's see. Oops, having a little bit of difficulty here with that. Let's see, we can go advance to the next slide. So what is retirement? Well, retirement may be different things to different people. Apologize. Some people may choose to continue to work. Other folks, they may want to relocate. They may want to travel. Everyone has a different plan for retirement. That's why everyone needs to plan differently for retirement. Having a little trouble advancing the slides. Well, one of the key questions I'm asked from folks is, can I retire early? And I'll tell you, one of the things that really holds people back from retiring before they're able to collect their Social Security benefits is the cost of health care. Everyone knows health care is projected to increase. And as a simple rule of thumb, it will require about $100,000 in cash savings for every 3 years an individual would choose to retire early. So that is one of the key components that keeps people working at least until they're able to receive their retirement benefit. Another question that often comes up is deciding to wait to retire. And I will tell you, it has its benefits. Deferred Social Security retirement benefits will increase by a certain percentage depending on the age and the date of birth of the client all the way up till age 70. When you reach age 70, however, you may want to start turning on your Social Security benefit if you haven't done so up to that point, because there's no real net advantage to deferring any longer unless you're in an incredibly high income bracket, in which case there are strategies that we can design that will allow to mitigate some of your tax burden. Working during retirement. I actually plan to work during retirement. I hope to teach either economics or personal finance at the college level as part of my retirement plan. My wife, for example, she loves the garden, and I would like to see if she decides to work in retirement. It would be nice to see her work maybe in a flower shop part-time, something like that. I think working during retirement a little, it helps you with extra cash savings. Maybe you can keep some health benefits. And also it helps keep the mind sharp, and it just keeps you active in the community and things of that nature. So there's a lot to be said for perhaps working in retirement if that's something you would choose to do. One of the key factors is, will I outlive my money? This is the #1 concern of baby boomers today. It's statistically probable for people to remain in retirement for up to an entire third of their lifetime. And if you think of the math on that, if the average person goes into retirement at age 65, 6, 7, and they live all the way out to 100, which may seem a little improbable by today's standards, although it is happening. With the advancements in medical science and everything that goes on in technology, it is quite possible that we may see folks living well into the early hundreds. And what do? Well, for starters, maybe you have to plan. And plan, and plan, and continue to plan and modify that plan and work with someone who's going to help adjust that plan across time. And that's what I'm here to offer. I want to offer my unbiased professional advice and guidance for Ardent members as a benefit of their membership. Here at Ardent, we value our relationship, and we want to help you achieve your retirement goals and realize your financial freedoms. And that starts with us really developing a relationship and digging deep and really getting to understand exactly what you are ultimately trying to accomplish. At the end of the day, I often tell clients that retirement is really all about income and cash flow. And it's extremely important to have predictable income in order to maintain the lifestyle that you would like, remain in retirement, and not run out of money while in retirement. So one of the key concerns that I also need to adjust and plan for would be Social Security. It is projected that Social Security may become insolvent by year 2035, according to the plan's trustees. Now, personally, I don't think Social Security benefits will cease to exist. However, these benefits may get reduced. And that is something that you really have to factor in when you're looking at doing a long-term sustainable financial plan. The next consideration, if you're so fortunate, would be if you have a pension. Not everyone has a pension today. They've kind of gone to the wayside. Back in the good old days, it was considered a three-legged stool. You would have your Social Security, you would have a pension, and then you would have your personal savings. And those three things would be what would carry you to and through retirement. Few folks today have a pension. I'll also say that in certain cases, it could be beneficial to take the pension lump sum option if it is given to you. Not all pensions offer that option, but of those that do, it's well worth sitting down with myself, the good people of Ardent. We can take a look if you want a period certain, if you want to include the spouse. If you take it as an individual lump sum, you'll never lose control of the asset. You start taking those withdrawals in monthly installments, you've ultimately annuitize the pension and you lose control of that lump sum asset. So it may really be advantageous to consider taking that pension as a lump sum. One of the other things we really like to do when planning is we like to identify the gap. And the gap is the difference between earned income during employment versus any passive income you would receive in retirement. That would include Social Security, it would include a pension. It would also include any sort of investment income, etc. So you add up all that income you receive in retirement, take that number, minus it from where you were having a working wage, and that difference is the gap. And at the end of the day, we have quite a few strategies that we can implement that are designed to help fill that gap to keep you in retirement and to make sure you don't run out of money while you're in retirement. Another key concern that we will address is the cost of health care, things of that nature. But before I move on to the next slide, I would like to open up the floor, see if anyone has any questions at this point.
Andrew, we do have a couple questions coming in. Our first one is, how do you determine how much is enough for retirement? Are there any tools we can use?
Absolutely. In fact, here, one of our key offerings, and it's quite exquisite, really. It's Money Guide Pro, and it's a software package that we use, and it allows us to do certain calculations. They do what they call Monte Carlo simulations, and they'll do 1,000 of those, and they'll have extremes from one extreme all the way through to the next. And then through the discovery process, we can then determine, will you be okay in retirement? Will you need to save a little more? Will you need to work a little longer? Will you need to spend a little less? Will you need to take a little more risk with your portfolio? And we can make those sort of adjustments either while working or in retirement and really pinpoint exactly where you would land on a degree of probability. And we really like to see about an 85% probability of success when we enter the information in the software and go through the discovery process.
All right, we have a couple more questions, Andrew. Another question is, should I invest after retirement? Yes, because inflation, it's sneaky, and it's very important to at least have a portion of your overall net worth combating inflation. And the reason for that is because the dollar loses its purchasing power every single day, incrementally. Cash, and I will mention this later in one of the slides, is a very good short-term investment. But over the long term, it proves to be one of the riskiest and one of the poorest investments. In fact, keeping all your money in cash, you're really electing to lose money slowly and perhaps safely. But you are losing money, and more importantly, you're losing the purchasing power of the dollar. So to answer the question, yes, it's imperative that at least a portion of your total net worth is actively invested in the financial markets to gain a rate of return that outpaces inflation. All right, and another question is, how often or frequently should my financial plan be updated?
Well, With a lot of my clients, I do what they call, I do a combination of actively and passively managed strategies that work in concert. On the active side, I am working as a fiduciary, which is a much higher standard of advice and the offerings that I give. And to answer that question, I would say that I have to meet with my clients a minimum of at least once a year in order to satisfy my FINRA requirement working as a fiduciary.
All right, Andrew, that was our last question for now, but I think we lost your webcam.
Yeah, it looked as though something had popped off there. I wasn't certain what that was. Let's reload it. Okay. And we can advance to the next slide. Thank you. And thank you for those questions. I really do appreciate that. Another key concern would be the cost of healthcare and long-term care. They keep going up, as everyone knows. And medical debt has been the leading cause of bankruptcy of the American people for a very long time now. To that end, we do have solutions that not only allow to mitigate these types of risks, but also to efficiently and effectively transfer wealth to the next generation. So if you're looking for mitigation of long-term care risk, most people choose to perhaps self-insure for that. Or if you have a legacy and part of your retirement lifelong plan is to leave a legacy, we also have investment solutions that will allow for you to pass on those dollars in the most tax efficient way possible to your loved ones. We have economy and taxes. Well, the economy expands and the economy contracts. Markets go up, markets go down. Taxes, however, this is Ben Franklin is famously quoted as saying, in this world, nothing can be certain except for death and taxes. However, to that end, we can allocate funds in a way that they grow both tax deferred and or in certain cases tax free. And at the end of the day, implementing those type of strategies can be a real game changer when you're making planning for such things as retirement, as well as simply growing wealth. When we look at risk, risk, again, much like retirement and many things in this world, it's very unique. Everyone has, they have a different expectation, they have different risk tolerance. So one of my key goals when sitting down with folks is to really get to understand their situation and to understand ways that we can implement strategies that are specific to such things as their time horizons, their risk tolerance, and their financial goals and their dreams, and really just try to develop a strategy that doesn't require us to take any more risk on than the client is necessarily comfortable with. And we even have strategies that I like to call SWAN strategies, which is an acronym for sleep well at night, and to allocate a portion of your total net worth into something that perhaps is designed to protect principal or give you at least some sort of downside protection against the markets. And that goes into, of course, asset allocation. Cash, as I mentioned, can be considered a very safe investment instrument in the short term, but it proves to be not a very good one over the long term. When it comes to allocation, what you want to do is you want to think of your money in different time horizons. Maybe you have 3, 6 months up to maybe a year worth of emergency cash savings. And then beyond that, you may want to start to branch out 3, 5, 10 years, maybe thinking along the way of things you may need to spend money on in the next several years. Maybe plan to buy a car in the next few years. Maybe you plan on taking a trip in the next several years, a pretty expensive one. Maybe there's other factors along the way that you want to adjust for. And then think of the longer term investments. Think of your IRAs and your 401ks. And I didn't touch on this earlier, but investing in a 401k is a fantastic idea. One, it allows you to reduce your taxable income for that particular year. Two, if you have an employer that's matching that 401k, you're buying yourself a pay raise. And three, you're putting together a lifelong system that is designed to allow you to have money when it comes time for you to retire. So it's also a longer term investment. Therefore, you can go maybe a little further down the risk spectrum than you would with sort of your shorter term investments. And at the end of the day, it's an important part of an asset allocation model. I often use things with clients, it's like a pyramid. And at the base of the pyramid, you want to have your insurances. If you don't have health insurance, you could be in trouble. If you have an investable interest such as a spouse's life and you have a mortgage, you really want to have some sort of insurance in place for that. You drive a car, you want to have auto insurance. All those insurances, 401k money, all those long-term investment vehicles belong at the bottom of the pyramid. Middle of the pyramid, you have your 3, your 5, your 10-year plan, and you want to mix it up a little with some of those monies. And the top of the pyramid, maybe that's your more speculative investments. Maybe you do a little trading on your own. Maybe occasionally you like to go out and buy some stock, or you want to do a small portion. I always encourage folks to maybe have a small portion of their to run a little of their own money. So that's where you would have those speculative plays more towards the top of the pyramid. And then we talk about personal savings. Now, when it comes to personal investment, it is important to save, and it's important to invest, at least in the interest of outpacing inflation, because over the time, the dollar loses its purchasing power. Equities, which are stocks and bonds and mutual funds and things of that nature, stocks more so, equities aren't really truly stocks, and they continue to be the best performing asset class over the long term. They tend to outperform cash. They outperform gold. They outperform oil. Equities outperform real estate. They outperform bonds. Over the long term, equities have statistically proven to be the best performing asset class over time. And it is really important to, if in the interest of generating wealth, to at least have some skin in the game and to have some equity exposure in your overall portfolio. Another investment vehicle that tends to get a good bit of bad press, I'll be honest, that the annuities. Annuities, they people are concerned. They don't like the term. They're concerned. They say the fees are high. Some folks, they tell me, the terms are long. The money is illiquid, so it's very difficult to access. And in certain cases, all those things may very well be true. But at the end of the day, what people don't understand is that an annuity, in its stripped down, purest form, is really just a vehicle that's designed to grow money tax deferred. The fees can be as low as 0. The terms can be as little as 3 years, spanning out to perhaps 10 or so, 3, 5, 7, 8, everyone's a little bit different. And they're all designed to do different things. There's also several types of annuities available in the market today. We have annuities that are designed to give a fixed rate of return. Currently, there's one trending that's 2.25% for a 3-year term. We also have other annuities that are designed to get maybe a better rate of return than that, and totally 100% protect your principal. Next up the risk spectrum, maybe you get true downside protection, and you participate in an index and a passive strategy over a series of years. And then we have annuities that are designed to generate predictable income for the rest of your life, and perhaps the rest of your spouse's life as well, if you choose to elect that option. So there are many different types of annuities on the market, and they're all designed with a specific purpose in mind. And if you use these tools correctly, you will find that they may end up being a good solution for a portion of your total net worth. And that brings us to personal withdrawal rates. And that's where like annuities with living benefit riders tend to shine. It used to be assumed that a safe withdrawal rate was 4% a year. And that's 4% of your liquid net worth. And by safe withdrawal rate, what we're referring to is you can draw 4% of your liquid net worth each and every passing year and not run out of money in retirement. However, since interest rates are so low, that withdrawal rate has been reduced to as little as 2.8%, which is to say that if you're withdrawing more than 2.8% of your net worth to live off of in retirement and you live to be 100, there's a fairly good chance that you may live long enough to run out of money if you're not getting the type of returns to outpace that withdrawal rate. And lastly, going back to Ardent, and thank you, folks of Ardent, I really appreciate, again, I work with wonderful people. We're here to implement solutions to help account for various scenarios. And at the end of the day, it's really all about planning. And in addition to all that I have to offer, here at Ardent, we have dedicated, talented people who can help you with various lending needs, such as mortgages, vehicle loans. We have a concierge service, which is spectacular. They will also allow to come in and negotiate on your behalf when purchasing an automobile. Of course, we have credit cards, we have savings, checking. We have a new service where we offer home and auto insurance. And much like myself, these gentlemen, they can custom design a policy for your specific needs. And often, in many cases, they can probably save you a little money doing it. Again, it's a complimentary service, much like mine, that we offer here at Ardent. Of course, we have online banking, we have online bill pay, and so much more. I will say, please, develop a relationship with a banker at Ardent. Come in, introduce yourself. You can ask to speak to me. I cover Bluebell, I cover Wayne, I cover Oaks, and I'm available 7 days a week to meet with clients. And I'd be glad to just introduce myself next time you're in the branch, or if you're not a member, please consider becoming a member of Ardent. There are wonderful benefits to being part of our Ardent community. And with that, I thank you for your time and attendance, and I will now open the floor up to any additional questions that anyone may have.
Andrew, we do have a couple questions that came in. Our first question is, if I have a Roth IRA and I'm under the age of 70, is it possible to withdraw without a penalty?
Yes, it is. Roth IRA provisions will allow for you to take out the cost base at any time without any sort of penalty from the government or anything along those lines. And the cost base would really be the amount of money you contributed, because this money grows tax deferred in a Roth. So therefore, once you are in a Roth and you're of age where you're over 59.5, I believe, you can pull out of your Roth without any sort of tax penalties at that point in time. I will tell you that I am not a tax professional, and our patented response to any tax-related questions will be, please check with your tax professional about anything tax-related, because at the end of the day, it's a slightly different industry than the one that I'm in.
All right, another question we had is, can you use assets of an IRA for a house purchase or a down payment?
There is a provision that is a 1031 exchange, and I know that we don't do those here at CUSO and or Ardent, but there are companies out there that do specialize in taking what they call qualified assets, which are monies that were growing tax deferred, and using them to acquire real estate. So such a provision does exist within our tax code. And again, at the end of the day, that's sort of a more tax professional question.
Okay, our next question is, in such a low interest rate environment, where do you recommend to get a decent savings rate?
Well, that's tough. It's a very hard thing to do right now, even with bonds being so low. You have to maybe look into some form of low risk mutual funds that offer a dividend. The dividend payouts on a lot of stocks trading in the S&P 500 or Dow 30 today are significantly higher. Those dividend yields are significantly higher than what you're going to find in regular investment rates, bank rates. The other option is to look into one of these annuity type of products, where, as I mentioned earlier, for as little as 3 years in time, you could collect maybe 2.25%. And you can do even a little better if you go out further lengths of time. But before making those type of determinations, it's really good to sit down with the individual and just like I've mentioned, get a sense of your situation and see if that is really the best solution for your money.
Okay, we have a couple more questions. Do you think long-term care is a good thing to have?
Again, that is up to the individual to decide. I did mention that, you know, one of the key things driving bankruptcy today is the cost of healthcare and not being properly insured. Those policies standalone can be somewhat expensive. However, we have other options, where you can maybe include a long-term care policy with inside either something in the way of a life insurance or even something that allows for one of three things to occur, where you can invest into a policy that if you chose, you can take your money back without penalty, use the money for long-term care, and if neither of those things occur, it'll be passed on as a legacy with considerable tax favorable treatment to your heirs. So I would say that, you know, it's an individual decision to buy long-term care insurance, but before you go out and purchase an individual policy, look at some of the more newer hybrid solutions that are on the market today. And that, again, is a conversation I'd be glad to have with someone on an individual basis.
Our next question is, what's the biggest mistake I should avoid regarding my retirement?
Well, everyone's of a different age. Everyone is of a different risk tolerance. A mistake that younger people tend to make is they're not allocated aggressively enough in their portfolio. Because as I mentioned earlier, equities are the best performing asset class over the long term. There's a rule of 72, which states that if you can grow your money at a rate of 7.2% a year, you should be able to double your money in every 10 years with that compounding. You can also take any interest rate and divide it by the number 72, and that will tell you how many years it's going to take to double your money. It's something to be mindful of, especially if you're a younger investor. You really want to be mindful of how long is it going to take for me to double this money and double this money again, and perhaps double this money a third time between now and when I retire. Conversely, as you're older, as you age and you get closer to retirement, you really want to dial back that risk exposure. As you get within 7 to 10 years of retirement, you really want to start moving some of those funds away from the more aggressive growth funds, let's say, and go into more, low risk mutual funds, perhaps into a different investment vehicle if you're able to do something called an in-service non-hardship withdrawal, which basically states you're in service, you're still with the company, non-hardship, so it doesn't harm you in any way to withdraw a portion of what you have in your 401k, and it is actually withdrawal, and redirect those funds into something that perhaps is a little safer than what's being offered in your current 401k plan. So there's some mistakes that could be made on both sides of the spectrum. It's really up to the individual, and it's really up to your age and how much time you have to grow this asset between now and when you plan to tap into it for retirement.
All right, our next question is, I'm worried about my 401k losing value. What can I do to mitigate my risk?
Okay, and that's fair. We are at a period where we are seeing some economic contraction. I look at something from Legg Mason that's the anatomy of a recession, and it's 12 leading economic indicators, most of which are pointing pretty negative at this point in time. Most 401k plans have inside them something in the way of a stable value fund or a short duration bond fund. Also, most 401k plans today, and they've grown in popularity, they have target funds. So if the target is year 2050, so it's a 2050 fund, that 2050 is a date and time, the year 2050. So that means you have 30 years, and as you get closer to 2050, that year and time, they readjust the portfolio and they dial down the risk. But there are things you can do within your 401k that will allow you to continue to contribute, continue to get the tax favorable treatment, continue your employer if they do to match, which is fantastic. And you can put all that money into either stable value, short duration, or some sort of bond fund that will be less risky theoretically than its equity counterparts.
Andrew, we have two more questions. Our first one is, what's your advice for someone graduating college and is beginning to start saving?
Okay, fantastic question. You know, it kind of goes back to the 401k again. It's very important to learn to pay yourself first. You really should target setting aside 10% of what you earn and investing it in some sort of way. I don't know if I mentioned this earlier in the slide, but generating wealth, it's not what you make, it's what you save. And it's not just what you save, but it's how you invest it. And that all starts with the saving aspect. Really want to start putting money away in your 401k, especially if you get a match. If you're not offered a 401k, what you may want to do is open an account and do what they call systematic investment. It's a dollar cost average strategy where money automatically comes out of your Ardent checking account and it goes right into a CUSO brokerage account. And every month you're buying into the market, and you do that consistently over time. And if you're younger and you're not planning on spending that money in the next, say, 5 to 10 years, it's not a bad idea to at least try to invest in a spattering of funds that are going to be a little more on the aggressive side. And if you can grow your money at 7.2% a year or more, you're going to do quite well later in life by doing that.
All right, Andrew, our last question is, what is your investing philosophy?
Well, it really goes down to a few of the things that I mentioned earlier. For my clients, it really starts with getting to understand their specific goals, their specific needs, their time horizons, their risk tolerance, and developing and implementing a strategy that is as bulletproof as I can make it. And throughout my career, I've used several different types of software, Money Guide Pro being the most recent, which I think is phenomenal for that. I read, I love to read. I think at the end of the day, the philosophy is that the market will go up over time and it will outpace other investments. And when things are at their worst, that's really where the most opportunity lies. And when they're cheering, I'm fearing. And you know, when they're running, I'm thinking that that's the opportunity. That's the time to buy in. It's very counterintuitive often the way the market functions. But if you invest for the long term, you will do well by just simply, you can do something as simple as buying the S&P 500 index and just let it unfold over 20, 30 years. And you would be in great shape.
All right, Andrew, that was our last question. Thank you.
Well, thank you all. I really sincerely appreciate your attendance. I thank you for the wonderful questions and the opportunity, really, just to come visit you folks in your living rooms, as I'm sure you are, as I'm in my home office. And I will turn things back over to Will at this point and just say thank you. And please, again, establish a relationship with your Ardent banker. And please, when you're in the branch, ask for me, Andrew Campbell. I'd be glad to take a few minutes to at least introduce myself and get an understanding of who you are and why you work with us.
Great. Hey, thank you, Andrew, for providing some great information, and would like to thank everybody for attending tonight. So there will be a short survey sent out, and would love to hear your feedback to help us improve for our future workshops. So please keep an eye out for other upcoming workshops, such as a cooking class, and we hope to see you soon. Thank you, stay safe, and stay well.